It's Dan Langer, the founder of Executive Capital. I help executives like you understand your stock options and equity awards so you can make smart decisions and live your ideal lifestyle. As I discussed in my previous video, there are 5 elements of a solid foundation with your stock options. Understanding what a stock option is, understanding the vesting schedule, knowing the value of your options, both the intrinsic value and the time value, and understanding the type of option, the non-qualified versus the incentive stock options, as well as the tax consequences associated with each. And last but certainly not least, when to exercise your options. The number one question I'm asked is, when should I exercise my options? In this video, I will talk specifically about when to exercise the options. Wouldn't it be great if you could have a basic template to assist you in the decision-making process? Well, now you can. So let's go ahead and get started. I think it would be helpful to spend a minute discussing the time value versus the intrinsic value. In the previous video, I explained that the intrinsic value is the difference between the exercise price and the current price of a stock. As an example, if the options were granted at 20 and the stock option is currently trading at 30, the intrinsic value is $10 per share. The other component that makes up the value of the option is the time value. This is the theoretical upside potential of the option. The key word there is potential. In essence, the time value of an option is like an interest-free loan on the exercise price, plus the potential increase of the value of the option. The challenge that the executive faces is what we call the option holder's dilemma, meaning the only way to protect the value of the option is to destroy the value. In other words, by exercising the option, you're destroying the value and protecting the upside, but you're also protecting the value by exercising the option and capturing the gain. So, what makes up this time value? First, time to expiration. The longer the maturity, the greater the time value is. Second, interest rates. As I had mentioned earlier, a stock option is like an interest-free loan. Therefore, when interest rates are higher, the option values are higher. And third, the volatility. Normally, investors prefer less volatility in their investments. However, when it comes to options, the greater the volatility, the more that an option is worth. And fourth, dividends. Generally, the greater the company's dividends, the lower the value of the option is. As the option holder, you're not entitled to receive any of the dividends, therefore making the option less valuable. I have seen several different strategies, or should I say methods, that executives have used in exercising stock options, and I will touch on each of them and then show you a simple method you can use that I feel is the most effective without the use of some sophisticated software. One method is called the first opportunity, or as soon as possible. As the name implies, this is when the executive exercises the option at the first opportunity. The advantage of this method is that it protects the profit of the option by exercising as soon as possible. But obviously, exercising on the first opportunity, any time value will be gone once exercised. This method would be the least risky. Another method is called the last opportunity, or as late as possible. While this gives the executive the greatest profit potential, it has the greatest risk by waiting to exercise the options shortly before they expire. Another method I have seen used is called the specific time period. This method is a combination of the first two. It is when the executive exercises the option based on a specific time period that is past the expiration date. That could be 4, 5, or 6 years, assuming that the option is in the money. This method is more favorable than the other methods, as this does balance the risk-return. However, the flaw in this method is that it assumes that the amount of time remaining before expiration determines the best time to exercise the options. The method I have used as an initial starting point with executives is called the profit percentage. The profit percentage is the dollar amount of profit by exercising the option divided by the current stock price. For example, if the current stock price is at $40 per share and the exercise price is at $30, we have a $10 profit divided by the current price of $40 gives us a profit percentage of 25%. If the stock were to go up to $65 a share, we still have the same $30 exercise price, but our profit is now $35 divided by the current price of $65 gives us a profit percentage of around 55%. Obviously, the greater the profit percentage, the more it makes sense to exercise the options. Determining what the profit percentage should be before you exercise your options really varies dramatically for each executive. There are several factors that I would look at in determining what the profit percentage should be in determining what options to exercise. These would include the concentration of your company's stock. In other words, what percentage of your net worth is in your company's stock, including the stock options. Also, the time frame until the funds are needed. If you're an executive in your mid-40s versus an executive looking to retire in the next few years, obviously the profit percentage would be different. Also, your risk tolerance and your attitude towards risk. And also, job security. How secure do you feel in your present job? In general, I wouldn't suggest exercising your options with less than a 20% profit percentage unless the option is getting close to expiration. Also, once the profit percentage gets above 60%, the majority of the time value has been recognized, and holding the option longer may not give a lot of extra return versus the risk of holding on to the option. Generally, the majority of errors that the executives make in determining when to exercise their option isn't when the profit percentage is in the mid-range, say 30 to 60%, but when the profit percentage is extremely high, like 80 to 90%, and the options aren't exercised and the stock drops substantially due to the overall markets or something going on at the company. In summary, I feel the profit percentage is a great starting point at determining when to exercise your options. As you may have gathered, the biggest downfall to the profit percentage is that it doesn't take into consideration the time value. In my next video, I will introduce the use of technology in valuing stock options that uses the Black-Scholes model and key statistics to assist us in determining precisely what options to exercise and when to exercise them.